Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shafianti binti Zabidin and my matric number is 265428. Today I will make a presentation about case study 5, which is Caribbean Brewers Transfer Pricing, Ethics and Governance. Question 1 is, how can the majority shareholder shift wealth through accounting, cost allocating and transfer pricing? In influencing the decision in such factors, the majority shareholders can shift wealth through accounting, cost allocation and transfer pricing. The majority shareholder in any corporation has very privilege when it comes to the decision making, since the shareholder is given complete control over the company. By that, the shareholder can be involved in making major choices regarding the company's operation and investment. In this case, which is Caribbean Brewers, Frederick Weston, Greville Gotler and Delos Grastak are considered as majority shareholder and BOD members who have a huge influence in making major decisions for the company. For example, most firms hold an annual general meeting, AGM, that will require the shareholder to attend the meeting and vote on various issues or agenda. If the shareholders are dissatisfied with the issue or agenda, they can vote for changes which are not always instantly implemented but still be changed from time to time. In instance, the majority shareholder can move wealth through dividend, and the dividend depends on the profit that be made by the company by allocating those additional costs and enabling the use of transfer pricing with subsidiaries to save on the cost. So, the parent company plans that all costs will be absorbed by Caribbean Brewers and they will sell it at the Gera Caribbean at the lower price. Hence, the profit of Gera Caribbean will increase and this will make the dividend that will received by the shareholder increase too. However, there are some disadvantages on the minority shareholders that might arise if the transfer pricing is conquered by the majority shareholders. Minority shareholders such as JJ, Edward Woods and Byron Jackson will be harmed by transfer pricing. Minority shareholders will not only see their share value decline, but will also receive no dividends since Gera was purchased. Profits are divided away from Caribbean Brewers and into the Gera Caribbean firms as a result of the transfer pricing strategy. Caribbean Brewing's bottom line is also suffering as a result of the bottle deposits. Previously, we can see that bottle prices were not incorporated into cost, but now they are considered as expensive to the Caribbean Brewing, which causes a detrimental impact on their bottom line. Shareholder will receive 50 cents for every dollar that be made, but the profit is recorded in the whole amount when it is transferred to the Gera Caribbean. So, this situation gives the majority shareholder an incentive to continue doing these practices. Now, we will move to the question 2. The question is, given the wording in figure 5 with respect to the taxation of related party transactions, to what extent is Caribbean Brewers vulnerable to tax risk assessment? So the answer is Caribbean Brewers are vulnerable to tax assessment due to inconsistent increases of cost and sale from 2007 to 2010. In this case, it's stated that the total production cost from 2007 to 2010 had increased from $27,065,750 to $55,997,800. So the total amount that increased from 2007 to 2010 is $28,932,050. However, the amount of total sales from 2007 is $6,375,000 and 2010 is $98,500,000. The increase of total sales from 2007 to 2010 is $92,125,000. We can see that this is an increase in the production cost of 107%, while increases in sales only by 49%. So we can conclude that there is a huge difference or gap increases from 2007 to 2010 between the total production cost and the total sales. The production costs in 2007 were only 41%, but in 2010 the cost rose to 57%. Based on figure 2, the production cost started to arise in 2009. This cost has been increased due to the increases in variable costs. Overhead had increased 3%, which is from 28% in 2007 to 31% in 2010, while variable costs increased 12% between the 3 years. The major contributor to this rise is in the variable cost of bottles. This rise from 0.7% to 9.7%. The main area that the company needs to give more concern, needs to target is in the export of Gera beer. The exports went from 55,000 in 2007 to 1,190,000 in 2010, which is it produced nearly 21 times more. This is significant because the $8 deposit is not being collected. It is also because of $8 per case of beer produced is extremely high, especially when a case is only selling for $50 per case. If they show bottle cost and deposits revenue separately, then computing production cost as a percentage of sales will be more realistic. Now we will move to the figure 4. In figure 4, it shows that 74% of Gera beers are exported to Gera Caribbean, which is located in a tax-free jurisdiction. Caribbean Brewers is selling a case to $25 to Gera Caribbean, and then they invoicing the case to other island for $50. From an auditor's perspective, this could be a tax evasion. In figure 5, Antigua Income Tax Act states that where a resident corporation carries on business with a non-resident corporation, and by reason of the relationship between such corporations, the cost of business between them has been arranged. Then the business done by resident produce less profits than those which can be expected to arise from the business if such relationship has no existence. Inland revenue may determine in a reasonable way whether any profit should be deemed to be accessible income of resident corporations. In 2010, Antigua had reported more profit than the actual amount, while Gera had reported less profit than the actual amount. Hence, the tax that they had paid is not enough. Next, we will proceed to the question 3, which is the last question. The question is, what are the implications of the composition of the board directors to the reporting of the CFO? The composition of the board members impacts on the full disclosure requirement for reporting by the CFO. The composition of the board members can give a huge impact on how the corporation makes any significant decisions and also in receiving approval. Many issues, including the financial reporting requirement from firms, are being decided by the Board of Directors, BOD. The CFO will have to listen and implement the decision that the board has agreed upon. The board will be in charge of the company's financial reporting and disclosure rather than CFO. This situation will leave a significant influence on the CFO complete disclosure during financial reporting. So, the Board of Directors, BOD, is supposed to be a neutral committee that looks for the company's best interest. Since Gera International controls 75% of the Caribbean Brewers, and therefore elects a majority of the BOD members, the BOD is likely to let those practices continue with trying to fix the approach. By that, JERA might lose important personnel to their competitors if the issues in the previous report are not addressed. JJ and other employees were used to their previous bonus structure and dividend payment, so the adjustment had a detrimental impact on them, and the organization could suffer if the crucial employee leave. That's all from me. Thank you.